All right, guys. Well, thanks, Kevin. That was a great presentation. An interesting chart. I've not been on Twitter recently just because of the writing a letter, and I'm trying to just not see anybody else's research at the moment. I'm trying to come in with my own stuff. So that's a really good chart, actually. Really, really interesting stuff. Related to this, I think there's something. When I was just trying to sort of put into words what I think at least is the approach that we invest here at Crescat, and how we strategize things moving forward when we come up with ideas. And to me, it's always been about identifying big macro trends and trying to express those views in the markets the most asymmetric way as possible through parts of the market or segments of the market that look very inefficient and offer very mispriced opportunities relative to those economic shifts that we think are going to happen. And that got me thinking, what is that thing that is happening today that is likely to be that big trend that Crescat is looking forward to? And to me, it's this migration of capital towards hard assets. And especially because of the inflationary era, the trifecta of macro imbalances. And I would say that this view has been solidified recently, particularly when we had the Russian invasion into Ukraine, and we actually had a few countries starting to buy gold and accumulate gold in a large way, and China has been notably one of them. And you can see here this resurgence of gold. How did it happen? Gradually, then suddenly is sort of a way to describe. And you can see the U.S. Treasury's holdings have been declining. So it's sort of a way of them to improve the quality of their reserves by replacing treasuries with gold. And it's such an important and fundamental shift in how central banks have been behaving recently. And I would say that most of the U.S. close allies, the ECB and Japan and Canada and so forth, they have not done this yet this closely, I would say. Majority of this has been happening through countries like Saudi Arabia, Russia itself, and also China and other economies, and even emerging markets we've seen recently actually accumulating gold as of late. So what is the sort of Michael Lewis big short idea today? And it, to me, comes down to the devaluation of fiat currencies and the need for us to look for investments that kind of fall into two categories. It's the devaluation of fiat currencies relative to real assets that have a limited supply, but also imperative for society in two ways. Imperative for society because they're commodities, and we need them to power the global economy. And secondly, it really is a commodity or a metal that is used as sound money, which is what's happening here with gold. And so that sort of breaks down. And when I look at this chart, I mean, there's a lot of interpretations. One of them is what I've just presented here until now. And if you go to the next chart, this chart is certainly not necessarily the reason for somebody to think that China is the next economic power that we'll see replacing the US and becoming all sorts of other things. Look, when we look at the monetary dilution happening in China today, it is drastically higher than even the US. And so I think that the imbalances that they're facing is actually what exacerbates their need for accumulating gold faster than other economies. And it's one of the main reasons what we're seeing that. I don't think that's necessarily why people like to say that they are playing chess and the U.S. is playing checkers. It's not necessarily what I think it's going on. Is I do think that they're in a much bigger need than the U.S. itself. And if you go to the next chart, because it's related to commodities, a lot of people think that China has the upper hand on commodities, and I think it's the other way around. And here's a great example. Bloomberg had some piece of news the other day looking at Latin America countries actually starting to impose tariffs in China on steel imports and other commodities they have been importing. And so those are big changes in the macro landscape when it comes to geopolitics that I think are important and relevant to pay attention to. And, I'm old enough, if you go to the next chart, I'm old enough to remember, oh boy, I don't have the right chart actually. But anyways, I'm old enough to remember when China was supposed to be, surpassing the U.S. economy. And we haven't seen that happen yet. In fact, that ratio of U.S. versus China, it's actually only gotten worse in terms of the U.S. now is about 60% bigger than China in terms of an economy. And the GDP of China has basically gone sideways. That stagnation of their economy, which is to me a kind of a Japanification type of issue that we had in the 90s with Japan, is sort of, to me, what China is facing now. And monetary dilution will be a way to relieve some of those issues. So done with China. Let's go to the next chart. So you can see, though, that this monetary issue is happening across the globe. It's not just in China, but in the U.S. recently, we're also seeing money supply actually starting to increase, which is a very not shocking, because monetary base has been increasing. And so that basically was leading the way for money supply or credit to start also, or an inclusion of credit in money supply relative to monetary base, in which we're starting to see some of that expanding now as well. And remember, this is supposed to be one of the most, one of the tightest monetary policies we've seen in history. And even with that, we're still seeing this further need of dilution of capital in order to alleviate some of the pressure in the economy, given this unsustainable move towards increasing interest rates and tightening monetary conditions in such a levered environment that we have in the US and other economies. Let's go to the next chart. And so now, Kevin was referring to this, and this is the headline that he was referring to in the Wall Street Journal, when not too long ago, in fact, it was September 2022, that the Wall Street Journal came out with this headline where it said gold loses its status as haven. And it's not shocking to see those things. That's what we call sentiment. You want to fade sentiment in a big way. I think there has been some sentiment shift even in some other commodities, which I'm going to point it out here in a minute. But gold itself is I don't think I've seen a time in history where gold has been making new highs and people have not shifted their views fully. I mean, and you can see this as I presented in the prior presentation, looking at the ETF funds in here in GLD, which is the most liquid ETF in the US or in the world, and still shows a 25% decline from its peak levels in terms of assets under management. So all those things are important here to consider as we navigate this, what we think it's going to be a secular bull market for gold. Let's go to the next chart. And so, one thing, this chart is courtesy of two people, or I guess, organization, Zero Hedge, and also Jonathan Frutcher, because he actually provided this to me as well. And I thought this was interesting because I've seen different quotes on this. The quote that I saw first, and I don't remember the name of the CEO, was actually speaking with Jim Cramer. And he claimed that ChatGPT uses 17 times more power, energy power, than a Google search. And then I see this research that was shared by Zero Hedge, which unfortunately doesn't have source, and they claim it's 10 times. And if you look to, there's an interview from Robert Freeland not too long ago, maybe last week with Bloomberg, in which he also claims it's 33 times. So I don't know how many times it is, but it's a lot. And so if we're going to be using AI and this language models that we're seeing across all these developments that we're seeing across the internet space and AI space is certainly something to be concerned about. In fact, if you go to the next chart, Bank of America did a research as well, and the arrow and the 2x there is my iteration, but basically looking at the average household consumption of electricity, and then if we see all sorts of things going electric, vehicle charging, water heating, space cooling, and all sorts of things that we're seeing. So if we go all electric per household, we're going to see basically a double of consumption here. And this is not even mentioning AI and other data centers and all those things that we're seeing as well that could certainly add to this case. So what does that come down to? Well, let's go to the next chart. Interestingly, Chile is the Saudi Arabia of copper when it comes. Well, I should say what Saudi Arabia is for the oil industry, Chile is for the copper industry, and they account for about 27% of copper production globally. So certainly is it's almost 1/3 of the entire production of the metal globally. And so you can see here that this decline in which we are retesting levels that we saw 12 years ago is something scary, and something to be worried about, especially when we see electricity demand surging now. I saw Andoran also, the oil trader, famous oil trader, which I have tremendous respect for the guy. I think he's made some really bold calls in the past and gotten those right. One of them being the oil prices going negative. I actually recall listening to him prior to oil prices turning negative, and he also claims that we may see some stupid numbers with copper. Stupid is my quote, but because I said that about gold, but that's I think that's very likely. And what we see in terms of the I think, and I hate to necessarily quote Bill Gates here, but he had a really good phrase at which he said, people tend to basically overestimate the short-term moves and really underestimate the long on the long run what is likely to the impacts that is likely to have in markets. And copper to me is a classic example of this, where we've gone from nobody talking about the metal to a surging prices, and now everyone wants to be an expert of why electricity consumption, why we're going to use copper and so forth. And here I am talking about copper too, but I promise I was I was in the line before. But go to the next chart. You can sort of see what's shocking to me is how do we fix this problem of supply? How do we adjust some of those issues? And here's a chart in which now there's a catch to this chart. Basically, you're looking at metal prices, copper prices in this case, and you're looking at producers capex, and now you're looking at metals and mining industry and capex adjusted by GDP. And you can see that there is a big divergence between the two. Now, you can also see that the white line seems to be a little bit ahead of the red line. Well, what does that mean? Well, that means that the copper price has a lead of 2 years. And so as metal prices rise, and there is a lagging effect in companies, mining companies, who start and spending money into new supply, new projects. And that's what we tend to see as we see them becoming more comfortable with a more sustainably higher metal prices overall environment. And so is this where we are today? Look, metal prices have been rising quite a lot already, and we haven't seen the producers really catch up. I would go out and say that maybe this might be the first time, or maybe in the 70s, we can perhaps something similar in terms of this lagging effect being more pronounced than prior years. I mean, yeah, we did see some level of lagging back in early 2000s. It's not shown in this chart because the copper prices, as I said, is already have a 2-year lead in this chart. So you have to adjust your brain to that. But basically, what I'm trying to say is, this seems to be different than prior times. I mean, this time, I hate to say the phrase, but this time feels like it's different because we're not seeing, and maybe it's ESG related and just approvals of new mines, but certainly we're not seeing it all. And I do think it's also the fact that investors have not deployed any money into the metals and mining industry. In fact, the overwhelming sentiment out there is that, yeah, gold, copper are going to rise and are going to do very well, but the miners are not. The miners are not going to. And I don't know where this is coming from. This is not backed by history, clearly. I don't think I've ever seen a time when you see metal prices having a run and that doesn't improve the margins of these companies. Yes, they are in a very complex and difficult industries to run and operate a business because they're always they're always dependent on metal prices in order to make money. And I do think that there are times and decades when you want to own these industries, and that's definitely now in my view because of the supply constraints that we have and all the demand side of things and this migration of capital towards hard assets. So let's go to the next chart. And you can see here, copper prices just had one of the largest 2-day declines we've had in the history of the metal. That those are the things that the markets do to you. Don't chase a trend, a short-term trend like this, because it's usually what happens. The markets will sort of test your conviction and shake out people that don't have the same level of conviction as we do, because we've been deploying capital into copper related assets for a long time. And it's just part of the game to see that type of volatility at times when the metal is trying to really start a long-term trend. And I think that nothing changes in terms of the case and the thesis for copper itself. These types of declines should be welcomed by investors that foresee the opportunity here, which is the long-term opportunity of investing in the potential for copper prices going significantly higher from these levels. And so that's sort of the idea. Let's go to the next chart. And so you can see here copper miners versus gold miners, and a chart that I used last week. And you can see that the red line is the copper miners and the white line is the gold miners. And guess what? Recently, copper miners have been starting to do much better than the gold miners. And still, a lot of people think that the gold miners will never catch a bid. Well, history doesn't show that. Usually, not only they follow copper prices or copper miners, but also ultimately, if gold prices continue to move higher, and if we do see this accumulation of central banks with the metal, and along with other changes in 60-40 portfolios, Kevin just had a chart of gold outperforming treasuries. Does that ring a bell about owning gold as a defensive asset, perhaps? No, I think that more. Look, who reported this? It was Bloomberg. And so more and more, we're certainly seeing that the mainstream media is figuring this out. And ultimately, what it translates to, in my view, is that large pools of capital are going to start allocating money into gold. And it's, as I said last week, there was a good chart that Larry Lepard actually sent out not too long ago, in which he had this idea of how much bigger the gold market, including miners and gold and silver market cap and so forth, by looking at gold metals above ground, was a much more significant size of the economy than what it is today. And so, can we see something similar, even if it's double from what it is today? No, I would say that there's definitely enough macro reasons to believe that as we see things developing here in terms of the green revolution, the reshoring, the central banks accumulating of gold and 60-40 portfolios, and this migration to hard assets, ultimately should drive the metals and mining industry also to become much more relevant. So answering that question from the very beginning, where is Crescat really seeing this big opportunity? The metals and mining industry is probably the most inefficient type of market. Inefficient in the markets mean opportunity in our view. And so this is to us where we've been spending a lot of our time trying to understand where are the best opportunities in this market. So let's go to the next chart. And so you can see here the juniors and seniors are starting to break out potentially, and we're seeing this today again. I guess GDXJ is up slightly more than GDX. Notice that gold is down slightly today, and actually, if you look at GDX, is up about 120. So it's also interesting to see that in down days of gold, or when gold or the metal is down for the day, we're starting to see the miners reacting better. And so those are times that I pay close attention to, because I think that if people are okay taking the risk on down days on the metal on a daily basis, that means that they're starting to get more comfortable with the asymmetry that the miners offer. Let's go to the next chart. And so you can see it here, large hedge fund that is trying to raise money with roughly $5 billion, in which they are claiming that will allocate 15 to 20% into commodities. Look, pay attention to those things. I mean, those guys are basically leading what we are probably going to see 10 years from now, which is, most of these large institutions that have very significant mandates that take forever, and there's so much bureaucracy to go over the hurdle of making changes in their own mandates, will take a long time to make their own push towards commodities. And so until the time they do it, most of the hedge funds already made their move. And so, I think this is quite timely and urgent type of environment to be looking into commodities, hard assets, and other things that might benefit from this transition of capital. Let's go to the next chart. And what Kevin was referring to in the chart that I was working on is this economic versus inflation surprise index, which is interesting. It basically looks at data that came out relative to what was expected. And if it's more than what was expected, the line goes up. If it's less than was expected, then the line goes down. And so it breaks down into inflation in white, and red is the economy. And so you can see the economic data specifically has been coming down, has been coming out worse than expected. And so we're seeing negative surprise. In fact, this is a collapse in the data of the red line. I think it's the biggest, it's the lowest number since 2019 or so. And you can see that inflation is starting to increase. And I made the whole stagflation, I broke down to two because Jay Powell said that he's not seeing the stag and not seeing deflation. Well, here it is in one chart. Hopefully this will get to his hands. Let's go to the next chart. And you can see that if you go back in not too long ago, the last time we saw these two lines diverging to the degree that we're seeing, it happened actually at the peak of the market in 2021 when we had the mega cap companies and some other technology companies, and we had a bunch of meme stocks. And that was a time when people said, do not short any meme stocks. And we had some short sellers going out of business. Now that was the bell ringing, by the way, of the market at the very peak of 2021, if you recall. So look, yes, the white line was much higher than what it is today. I think what's the importance, but also the red line is lower. And so, I think what's important here is the fact that, we are seeing economic data coming out drastically below expectation, and inflation is proven to be quite sticky. And so that's the bottom line. And that usually, is a way of describing or defining a stagflation per se. Let's go to the next chart. And so here is Shanghai freight costs. It's something I've been paying close attention to. I've had a chart of this in the prior presentations, but this keeps developing. And we've had another big increase. If you look at the 2-week changes in freight costs in Shanghai, you're seeing one of the largest we've seen in history. If you go to the next chart, you can also see that the global freight cost has been increasing as well, and because the Shanghai tends to lead global freight costs. These are all very inflationary trends because think about how much goods the U.S. actually imports and the type of impact we may see in those prices of those goods over time, given the fact that we're seeing potentially a second wave of freight costs rising. Those are things to be very much aware of. Let's go to the next chart. And so you're starting to see commodities, break out in different parts of the commodity space. The agricultural commodities is taking a break, and now we're seeing the metals. Those things, notice, these things rotate all the time, and we're seeing that again. Now, energy is sort of trying to make a comeback. Metals and mining are again hot, or metals are really hot right now. Most of the metals are rising significantly in the last month or two. And agricultural commodities that were the hot ones a month or two ago are now taking a break. And so guess what's going to happen? Well, they're going to keep rotating. And so when people start focusing on agricultural, the market starts focusing on metals. And that's what's probably going to be the case. And is it the end of energy? No, probably most likely energy will be the next one to rotate into. And so, I'm paying very close attention to all sorts of parts of the energy space, because I do think they've been sort of in a consolidating phase for a while, and they're probably likely to be the next ones to be moving as well. Let's go to the next chart. And just to finalize everything I said and sum up everything I said, is a chart that I've used in the past, and all credit goes to Increment AG and Roni Sterfole and the guys from In Gold We Trust report. And they actually use this chart quite a lot in their reports. And I think, an investor should almost live by this chart and really think, the best way to express this opportunity in markets by looking at this. Because when I stumble into this chart, and a lot of people, when they look at this chart, people that are usually want to be skeptics, they say, well, Tavi, what makes you think that we're going to see another 10 years? Because we've been in the sideways lines for 10 years. Do you think we're going to see another 10 years? I don't think so. I think things ultimately revert to their mean. And, I'm a firm believer of that, and seeing those CapEx trends and all sorts of signs of the supply side of commodities being so constrained, makes me believe that this is probably near the end of this sideways move on commodities relative to equities. And have we seen most of the returns in equity markets for the next decade? I would think that if not, we're very close to it, because it's been sort of doing exceptionally well, and equity markets don't do that for too long. People start extrapolating things for too excessively, and that's when things get ahead of themselves. And maybe we're getting there with equity markets, and so makes me believe that I think we're very close to a pivotal moment here where this line starts to really move in the upward direction.